That's good to see. We got a good mix of mix in the group today. All right, then one more question. How long have you been trading? I just want to get a sense of how long you've been trading, and kind of throw in there if you haven't been trading long, or if you've been trading long. Do you think you're consistently making money in the market? A lot of folks here are probably getting a little bit more information. Lots 2, 5, 4 years, haven't been trading at all, no consistency at all. So we have a pretty diverse group of folks in here. But the one thing I see is, over the last few posts there's a lot of people that are saying consistently losing money or not consistently trading at all. So I will ask you one more question, and this is probably an important question. Do you, of course, desire the knowledge to be a consistently profitable trader? In other words, do you want to make money? And I'm pretty sure I know the answer for this. That's really an easy answer right there. Of course you do. So as I get started, I only have a little bit of time today, so I'm going to show you some basic technical analysis skills I use in my trading and in my live room every day. So I want to start off a little bit, since we have such a mix of traders, I want to start off talking a little bit about what the Forex is, because not everybody knows what Forex trading and what it's all about. And then I'll look at some indicators that I use every day and how I employ them in my own methodology, which I kind of call bumps and barriers, or speed bumps and barriers. First off, just so you know, Forex is a shorter way of saying foreign exchange. Simply put, it's an over-the-counter market specifically for buying and selling of world currencies. And the Forex market remains kind of a unique market, different, let's say, from the stock market for a few main reasons. Let's talk about some of the unique features. First off, when you think about the stock market, you think about several exchanges like the New York Stock Exchange as a central hub of trading stocks, primarily in the U.S. With the currency market, there's no real central hub. It's solely traded electronically through world banks. Also, the volume traded in the Forex literally dwarfs any of the other major markets, and is being traded since there's nearly $4 trillion a day traded in the U.S. market, or in the currency market every day, and that dwarfs all those other markets. And another feature that entices a lot of traders to Forex trading is the ability to trade just pretty much anytime you want. The Forex essentially follows the sun around the globe 24 hours a day, from 5 p.m. Eastern Time on Sunday evening to 5 p.m. Eastern Time on Friday, giving you access anytime during the trading week. Now, there are also some other considerations that make Forex unique. Of course, high liquidity, very high liquidity. But what does this mean for you as a trader? This means that in most cases, your decisions to buy or sell a currency will be instantly accepted because of the massive amount of volume flowing through the market at any given time. Another reason people are drawn to invest in the Forex is the leverage capabilities. Even with a small investment, traders can leverage or control a large amount of currency, giving you the chance to make a decent amount of profit with really just a little bit of risk capital. So just as an example for those folks that don't really know what currencies are all about, here are some currencies that are traded in this market. This is just a small sampling as an example. The first thing that you need to understand is that currencies are traded in pairs. Currencies are traded in pairs. In this list, you can see a few of the most common traded pairs. Many times, when many of these have the U.S. dollar as part of the currency pair, you might even hear them referred to as kind of a nickname or slang for the other currency in the pair. Like you might call it the U.S. CAD, the loonie, or the cable for the GBP USD. Now, each currency pair has an associated exchange rate within the currency market. And this exchange rate is a reflection of the value of the base currency, which of course is the first currency in the currency pair, or the counter currency, which is the second currency in the currency pair. So taking a look at the example that I have here on the screen, if the exchange rate for the EUR-USD, or the euro versus the US dollar, is 1.3024, then we would read this as 1 euro is worth 1.3024 US dollars, since of course the euro is the base currency and the US dollar is the counter currency. Now, currency price movement is measured and referred to in pretty small increments, or really the last decimal place in that exchange rate. And we refer to this movement as a pip, as PIP, as a pip. Now, as you can see, an example that I have here in this little table here, let's just look at the GBP/USD, the pound versus the US dollar. The price went from 1.5600 down to 1.5540. And we would look at this as a change of the price of 60 pips. From 5,600 down to 5,640 is that 60 pips. Or we could look at a different currency pair. Let's look at the USD JPY, for example. The price went from 98.10 up to 99.35, which is a change in price of 125 pips. So that's how we're going to measure currency price movement, using those exchange rates. Now, when a currency trader is looking to open a long or short position, either way, they will need to, of course, commit a portion of their own funds. They're going to invest some funds to make that transaction. And currency trades, we take them in what we call lots, L-O-T-S, lots. Now, a lot is a fixed amount of capital engaged in the market at any given trade. Now, as you can see here in this table, there are amounts of capital engaged for a standard lot, which is $100,000 engaged for a lot. A pip value at a standard lot is about $10, depending on the currency pair you're trading. For a mini lot, the amount engaged is $10,000 for about $1 per pip. Remember that small unit of the exchange rate. And lastly, for a micro lot, the amount engaged for one lot is $1,000 for a 10 cents per pip. Now, if you're new to Forex trading, these amounts of capital engaged, or those lots, might seem very large, but the amount of money that the trader, you as a trader, would need to provide for that lot traded is only a fraction of the amount of this, and that's because of those leverage capabilities of the Forex. And it will depend on the different type of account that you have set up. Which brings me, of course, to that leverage setup that we talked about and the good leverage opportunities in the Forex. Now, as I mentioned before, one of the enticing features of the Forex is trading is the leverage capabilities available. So with leverage, the trader is only required to commit a small amount of their own capital or own funds to be able to control a larger amount of money per lot traded. And it's important to acknowledge that a portion required for the trader will vary depending on the broker your account is with and the account setup and which currency pairs you're trading. So it's important information that you need to know before you're entering a currency trade. But for the examples that you see here in this table, the amount engaged, or the amount that you're committing for one mini lot, is $10,000. However, the portion that you're going to need to be investing to control that one mini lot at a 50-to-1 leverage setup is about $200. Or if you had a 100-to-1 leverage setup with your broker, it would be about $100 to control or leverage that $10,000 in the market. Next, I want to talk about some of the basic technical indicators that I use in the Forex market every day. I just wanted to start with a little bit about the Forex. Now we're going to talk about some of those technical indicators that I use to get in and out of the market on a daily basis. So here we go. First off, take a look at this list of some of the technical indicators that are available to you. Now this, of course, is just a few of the indicators out there. There are dozens to choose from, and there are multiple variations of many of these, like moving averages, and not to mention the different interpretations and uses of tools like trend lines. So just how do you decide which ones of these that you would want to use? Because you could spend months or even years trying each one of these, and you might have some success, but more than likely a lot of failure. Now, of course, I'm in no way saying that all of these are bad, because used correctly in the right market conditions, each has some value. But just think, if you tried to apply only half of these to a chart to interpret the market, you could barely see all of the movement in the market because of all the lines, the bells, and the whistles that you'd have on your chart. So just how do you whittle this list down and begin developing a winning trading strategy? Well, I personally believe that the path of least resistance is always going to be the best way to get what you want. Now, for me in my trading career, I wouldn't exactly say that's what happened. When I first got started, I worked under a mentor. In fact, I went around and found what I thought was the best mentor in the business. Well, of course, that's at least what he told me that he was. He told me he was the best mentor. And for lack of a better way to say it, he really was just an average trader. And the worst part about it, he's a pretty awful mentor. He was a worse mentor than he was a trader. And I got a bunch of stuff thrown at me and left kind of to work it out on my own the best I could. Man, I was kind of frustrated for the first several years, to say the least. I was losing pretty bad. And of course, I didn't know it at first. In fact, it took me a pretty long time to realize that I could never be profitable trading the way that mentor taught me how to trade. How many of you out there have probably seen that similar situation? You probably can relate to this story pretty well. You know, you go out there, you find a mentor, you work really hard, and it seems like you actually are losing ground. And at some point, like me, you probably came to the realization that, you know, this just isn't working. And for me, it took 5 years of trading to come to this realization. Then I had to make a really hard decision. I had to hit the reset button and basically start all over from scratch. You heard me right. 5 years, 5 long years of ups and downs with no consistency, all the while trying my hardest to dedicate all of my time to trading and then have to start all over from scratch. Now, this was a tough but necessary decision. The good thing is, not all was lost during that time period. I did learn a lot. In fact, I want to talk a little bit about what I learned. I realized that there are some clear obstacles I was facing, and removing those obstacles would be the first step of getting on track. One of those obstacles was information overload. I was spread way too thin. I was watching so many of those indicators from that list that I showed you a little bit ago. Remember that list? I realized that I need to keep it simple. So I picked a few of those indicators that made sense to me, and then, and you know, for you that could be 1 or 2 or 4 or 5. But the key was to pick a few of those indicators and stick with them. Now you can, and by sticking with them, only then can you really master those indicators. You see, I realized it was better to master a few than to be a slave to so many, which was what I had been doing. Now, once I settled on a few of those indicators, I worked on mastering them. I became their friend. I got to know them inside and out. I knew that to better understand how they worked, the better I understood them, the more useful they were going to be, and the more successful I would be. The next key for me was to develop a strategy around those indicators that I could trust, and then apply them consistently. And this is going to be an important thing. And I applied it consistently. Essentially, I was going to have to use the same strategy the same way every time. Some people out there probably think consistency means that they're going to win at every trade. And I heard previous speakers talk about you're not going to win at every trade, or you might not even win at almost every trade. But that's not what consistency means. Even when you're a consistent trader, you can and will have losing trades, that's for sure. So I realized I needed to develop a strategy that works consistently over time. And for me, trading is not about 1 trade or 10 trades for that matter. Trading is something that you work at over dozens or hundreds of trades. And even if you follow a similar strategy over time, that is consistency. Now, I see traders all the time that tell me they want consistent results. So the first question I ask them is, do you apply your strategy consistently? And, you know, do you stick to your own rules? And of course, most people don't. Consistency doesn't happen on accident. It's not like one day you trip on a curb and fall into a big giant pile of consistency. You get consistency from acting consistently. So let's talk about the next obstacle I had to identify. And I was roped into the concept of proprietary trading, meaning the indicators and even the charts I was using were not widely used and taught. And this was the problem. So I learned the importance of using commonly known indicators. And I picked ones that are well known, that a lot of traders use. First off, the reason I decided to do that, because there's going to be more training and information available on how to use them than you would, of course, find for a lesser used or lesser known indicator. Secondly, there's a reason why they're probably commonly used, because when used correctly, they work. And that's really the key name of the game. You want to use something that works. So don't try and invent the wheel here. Another thing I realized is in the market is it's driven by buyers and sellers. And of course, if you're using very common indicators and it's giving you obvious buy and sell signals, the chances are that you're not the only one that's seeing that signal. And if everyone is seeing the same buy or sell signal and everyone buys, the market goes up. And hopefully that makes a little bit of sense. Now, getting to my trading strategy, I generally stick with the major currency pairs. I look at them somewhat like indicators. There's a lot of different currency pairs to choose from, and some of them are a little bit more volatile than others, and some have higher trading costs. Some will make you more money per pip, and some will make it a little bit less, but each has its own personality. It might even be that you just want to trade the currency pair of your homeland, and that's fine. But what I say is pick the ones that work best for you. Get to know the personality of the pair. However, whichever pair that you choose to trade, the strategy that you apply to each pair will remain the same. And then, of course, you're going to apply the indicators that you choose from that big, long list. And that's what I did when I formulated my own trading methodology. And when I did that, I decided to call it something like speed bumps and barriers. Now, for simplicity's sake and the time today, I'm going to talk about classic barriers in the market called support and resistance. Now, these are classic barriers in the market. However, there are many forms of indicators that you can use to identify these types of levels, these barriers in the market. First off, of course, you could simply draw horizontal lines that represent those historical barriers in the market of support and resistance, but that's really just the beginning. Additionally, you could use tools like Fibonacci to mathematically identify naturally recurring levels of support and resistance, or you could simply use pivot points. Those are levels that are calculating potential support and resistance using historical data from the previous day. Or you could use a multitude of variations of moving averages to project potential support and resistance based on price averages. Whichever way you decide to, or whichever method you decide to use, they are all primarily doing the same thing. They're identifying levels or barriers, or what I like to call bumps in the market. And these are fairly easy to identify once you know what to look for, which of course in turn makes them a widely used common indicator. And what I like about support and resistance is that you can look back in time, days, weeks, months, or even sometimes years, and find the market has recognized these levels over and over again. So as with any barrier or bump in the market, there are two real main potential scenarios with these support and resistance or barriers in the market. And these are going to be the key decision points that you will need to recognize when you're deciding to take a trade or not to take a trade. First off, there's going to be a potential bounce point. This is where the market stops or stalls for a period of time, maybe short period of time or maybe long, and then reverses and goes back in the other direction. The next scenario is it's a potential breaking point, and this is when the market passes through one of those speed bumps, like I like to refer to it, or barrier, and continues in the direction that it was previously moving, or the direction of the trend. So let's talk a little bit about that trend. Of course, trends are important. Trends are the overall direction a price is consistently moving over time. And there are, of course, short-term trends, there's long-term trends, there's medium-term trends. But of course, the one thing I can tell you for sure about trends is that trends can and will change. And of course, it's going to be important for us to be able to recognize clues to those trend changes and at the point when that trend changes. And there are many tools that we can use to identify the trend and identify when the trend may be changing. So what all of this boils down to, what I've been talking about, is that there's just a lot of information out there, information overload, some of it useful and some of it not as much. So avoid getting bogged down and stick to what works for you. Then choose common indicators that give you the best picture of what the market is most likely to do. And then, of course, once you've chosen them, master them. Really get to know them and how they work and fit into a successful trading strategy. And what I found that works best for me is using indicators that identify support and resistance. And these are those classic trading tools that, of course, new and experienced traders come to rely on pretty heavily. All right, so I want to, now that I got all of that information out of the way, I want to take a look at some examples that illustrate exactly about what I've been talking about here. So I'm going to start here. We're looking at the euro pound, the euro GBP here on the 1 hour chart. And we can clearly see after the fact, of course, that this has been in an uptrend. It's been going up. And the way I simply identify an uptrend is higher highs and higher lows. Higher highs and higher lows. And of course, I've drawn a black trend line on the bottom of those supports to visually represent the trend. And I think it's important for you to understand that trend lines, the black line that I have here on the bottom of this chart, the trend line is not the trend. The trend is the fact that the price action, the price of this currency pair, went from a low down at the bottom to a high at the top. So that's why I try to define the trend as having higher highs and higher lows. The trend line is just a visual tool that we use to recognize that trend. And of course, the reason I draw it on the bottom is because during an uptrend, the price continues to rise, showing the market's difficulty to make a new low or new lower low. Now, I've also highlighted some of the main barriers on this chart, the main areas of support and resistance. Now, when I'm looking for these levels, like you can see here with the, I'm going to get the little tool here, like you can see here with this blue shaded area here or the purple shaded area, when I'm identifying these levels, I'm looking for clear areas of market congestion where multiple candles confirm that barrier. So as you can see here along this blue shaded area, it found resistance or a barrier on the top in the blue shaded area where it got underneath it, had a difficult time getting back above it, and now has fallen back down to the purple shaded area. But consistently over time, you look back in time, you can see it found resistance back here on the left-hand side or even on the far left-hand side of that blue shaded area. And the same thing goes here with this purple shaded area. You follow it backwards. It's obviously currently finding support right now. But you follow it back, it found support here and back here, and even some congestion along that purple shaded area. And even further down into the green zone, we could see some support here and some congestion back in the past. So again, what I'm looking for is a main area of congestion or support and resistance where the market can either do one of two things. Remember, there's two scenarios. It's either going to bounce or break. Now, in the current market on the right-hand side, it's holding underneath the blue zone. And conversely, it's finding support at that purple shaded area. Now, I've also used another tool here to help me identify these support and resistance levels. I've actually taken the Fibonacci tool using Fibonacci retracement levels from the lowest low back to the highest high. And we can see that the top fib, the 0.382, sits right here in that purple zone. The 236 fib is in the blue zone. So Fibonacci not only helping us identify the barriers here in the purple zone and the blue zone, but also into the green zone and the gold zone where our next retracement levels are. So here's the thing. Right now, we know that the blue zone is a resistance barrier. As long as it stays underneath it, there's potential for it to go back down. The purple zone is a support barrier. As long as it stays above it, there's potential for it to bounce back up. As you can see, it has done over the past several 1 hour candles here. But if it breaks through that barrier, that purple shaded area, we might expect it to continue to pressure lower. And that's what we might expect to see. So if we were to get into a sell on the break of the trend line and a new break underneath that blue shaded area, and as I go to the next example here, you can see it broke underneath that trend line, stayed underneath that blue shaded area, and then continued down. If we were to have sold it on the break of that trend line underneath 87.25, we could have placed our stop above a technical high near about 87.90, and as a result, we see a complete shift in this trend, and it ended up being a run, a much larger fall, as you can see here, as it moved all the way down into the 84.40s, which was about 280 pips. That would be about $280 on a mini trading account trading one lot, or it could be $2,800 if you were trading a standard lot. Let's take a look at another example here. I'm going to move on over to the this one happens to be on the USD CAD, and here we are. Again, this is a 1 hour chart, which represents each one of those candlesticks or those blue and red lines that you see here is a 1 hour period of time. And back on February 7th, we can clearly see this pair has been in a downtrend. But the evidence for a change in the trend is beginning to mount, and that's what I'm trying to get you to understand here. Trends are nice, but we're looking at a change in the trend potentially happening. First off, the bull market down at the bottom right-hand side has driven the price back above the trend line, but really not just above the trend line. If we follow these shaded areas back, and I've just shaded them for us to be able to easily find them, we can find historical support and resistance along this gold or yellow shaded area here. Remember, a support and resistance area is a level of consistent support and resistance along that level. So what I'm looking for is multiple attempts, whether it's support or resistance in that level. So we see some resistance here. We can see some support over here in this area. We can even see the market ranging between the blue and the gold zone over back in this area between this blue shaded area, finding resistance and support. So we know that it's finding a barrier here in the blue zone. If it breaks through that barrier, then we would expect it to go back up again. If it holds underneath it, we expect there's potential for it to continue to pressure lower. Even following that gold zone backwards even further, we see an area of consistent resistance right here and support over here on the left-hand side. Following the blue shaded area backwards, we also find we're currently finding resistance in there, but even further back we find resistance. So how will we know if this is going to be a bump where the market passes through and continues in that direction, or a barrier? Well, we just don't know, but we're going to use our tools to help us identify these levels of decision making. So we take Fibonacci also from the low back to the high of this previous downtrend. It's also helping us identify these clear areas of support and resistance. Taking this gold shaded area here, we find the 236 fib sitting there, Fibonacci retracement level. The blue shaded area has the 0.382 Fibonacci level there also. Going a little bit higher, if we break through this blue shaded area, which is our current area of resistance, where do we expect our next level will be? Well, if it breaks through this blue shaded area, I can clearly see the 50% retracement level of this same downtrend sitting right up here. And if we follow that back, we can clearly see back in time that there was some historical support lined up along that level. And we can easily go back all the way back up within this previous downtrend and see how all of these Fibonacci levels continue to consistently over time help us identify these historical areas of support and resistance. So now, if we think of them as barriers, a barrier is a place that could bounce the market in the other direction, as we can see that the market has done here in this blue shaded area. It came up, it broke above the gold shaded area, came up into the blue shaded area, found resistance. Now coming back down. So what do we expect here? Now that we've seen the market break above this trend line and these previous lows or previous highs that we see here, we're looking for support. What we know about support and resistance is that support can help us identify resistance. Resistance can help us identify future support. So we know that when it was finding resistance under the yellow zone, once it got above there, that would become support. So not only is it breaking above this trend line, breaking above the 236, and breaking above this yellow shaded area that we see here, it's now going to act as support. So if we're looking for a new buying opportunity, as the trend line is being broken, we're looking for a new buying opportunity as close as possible to that gold shaded area. Now let me go back to my analogy of speed bumps. I've talked about this many times in my live trading room. I think of each one of these levels, whether it's the green, the gold, the blue, or whatever color it is, or the trend line, or the Fibonacci levels, I think of them somewhat like speed bumps. If you're thinking about a speed bump, when you're driving your car through a parking lot, you approach a speed bump, what do you expect to do? Well, typically, when you approach a speed bump, you're probably going to slow down a little bit. Okay, you're going to slow down a little bit until you get over the speed bump. Well, when do you accelerate again? When do you accelerate again beyond that speed bump? Do you accelerate when you get your front tires over the speed bump, or when all four tires get on the other side of the speed bump? Well, most people accelerate when they get all four tires on the other side of the speed bump. So what I'm looking for, when I'm looking for the break of a barrier or support and resistance, is a clear open and close above that speed bump. So once I see that there are candles above that yellow zone, I know that that speed bump has now been broken. Now coming back down into that speed bump, I now expect once it's broken above it, that becomes a barrier that's going to keep it from going back down again, or at least for a period of time keep it from going back down again. So that becomes a area that you'd want to buy it in the direction of a potential trend change or trend break. Now once it breaks above this blue shaded area, the same thing. If it opens and closes above the blue shaded area, we expect it to continue to pressure in that direction. Now moving ahead, as I move ahead, we can see even here on the US CAD, now I've shifted that same currency pair now out to the 4-hour chart, and we can really see what's happening here. Not only Is it breaking above the trend line that we had drawn on the 1-hour chart? It's broken above that trend line and starting to create higher highs. We're also coming off of a retracement of this previous uptrend. So the previous trend was up. We see the current downtrend is merely a retracement of this previous uptrend that we see right here. Not only that, it came back down here into this area, which is historical resistance back here on the left-hand side. So if you look back here on the left, you see historical resistance along this black horizontal line. And really, the turn higher above the shorter trend line is really a turn back in the direction of the uptrend. So if we were to take a buy on the open and close above that trend line in the direction of the previous trend, it would likely be somewhere around the 99.80 level where the market was currently above that trend line. Our stops would go below the lowest lows that we see here in this area highlighted just underneath as the support where that black horizontal line is. Now going forward, if we were to have taken a buy on the break back above that trend line, we could see that the market did consistently move higher and moving all the way up into the 1.0300 level and leveling off up there for about a move of about 330 pips. Now, of course, trends are nice and changes in the trends are nice, but if you continue on, there's also those times when the market goes into ranges and we're looking for breakouts. And so as we look at our next example, we want to look at some of those times when the market goes into some ranges. So here the trend has been clearly in an uptrend. We look all the way back to the left-hand side. Here we're on the NZD USD on the daily chart. This is the daily chart. So each one of these candlesticks represents a daily time frame. This has been in a steady rise since May of 2012. However, between December and February, it's been bouncing around between two highlighted areas at the top of this trend. You can clearly see the multiple tests of resistance along the purple shaded area, clearly defining that as resistance, and support along the blue shaded area. Even historical resistance on the left-hand extreme side of that blue zone. So if you follow that blue shaded area backwards, you can find historical resistance back here, so we can clearly identify this. So that right now, that blue shaded area is a barrier in the market. We know that if it opens and closes underneath that, if that blue shaded area is a speed bump, remember that analogy of the speed bump, if we see a clear candle open and close underneath it, then we would look for a clear move or a change in the trend for this to continue to pressure lower. As long as it stays above it, as it has for the past several weeks here, into that blue shaded area, there was consistent moves back into the purple shaded area. Now, if we were to have been taking buys in the blue zone, our stops would go just underneath there, expecting a move back in the direction of the trend, but also watching out for a clear open and close back underneath the blue zone. Now, taking that information also back down to the daily chart here. Here on the daily chart, or actually this is the 4-hour chart. Here on the 4-hour chart, we can clearly see many opportunities as it dipped back down here between this area, inside this blue shade area, between, we'll talk about all the way back into January. Between January and February, we saw multiple opportunities for stuff to go back up. Now, if it clearly opens and closes on the daily chart underneath that blue shaded area, we would then look for it to continue to pressure lower. So buying into the blue zone would be our main focus. Selling into the purple zone until on the daily chart we saw a clear open and close, which would tell us that it was going to continue in that direction. Next, moving over to the GBP AUD, the pound versus the Australian dollar. Again, what I'm trying to help you to understand is these areas of support and resistance are the main decision areas that the market is looking for buying and selling. Once we see these areas identified, so let's take this purple shaded area, follow it backwards. This was a clear area where the market was finding resistance there again. It was finding resistance there multiple times. We go back and there's many times where we can find resistance along there, but also historical support. So support and resistance levels are historical areas of congestion, not a single candle body or an area where the market is just one time spiking into that level, but it's a historical area of congestion. Now we can see that it's come back down into that area and now finding support along that same area of historical resistance. Same thing goes down here at the bottom. we could see multiple times testing into this blue shaded area down here at the bottom. So if the market comes back down here at a later date, we know that there's potential support there. And remember, all of these are going to be potential barriers. I like to think of them as battle zones in the market, where the market will battle back and forth. Buyers and sellers are looking to jump out of the market, and vice versa. So here into the purple shaded area, for a pretty long period of time, the buyers were trying to drive it back above that purple shaded area, and the market consistently fell off of it. Only when it broke above it did we expect it to continue to pressure higher. Now the same thing coming back down into that purple zone, we can expect to see that it could go back down if it breaks underneath it. But of course, a holding here into this purple shaded area, we could see it continue to pressure higher. Moving on from here, we go over to the GBP JPY. We're looking at the pound yen, and we're going to start here on the 4-hour chart. And again, this pair has been in an uptrend, and this gives us a good idea of when the market is breaking out of one of these ranges. So here I have an area highlighted in blue showing our consistent area of resistance. The market's finding a barrier, having a difficulty getting higher. So it's now also broken underneath this purple shaded area. So we follow it backwards. We can see support here, support here, support here. So an area of consistent support here on the 4-hour chart. And again, I go back to my analogy of the speed bump. Once it breaks underneath that speed bump, what do we expect it to do? Once it gets on the other side of the speed bump, just like when you're driving your car, you expect acceleration. So now that we've seen it underneath this purple shaded area, what's our expectation? Our expectation is that it goes back down to the next speed bump. And so that next speed bump, and I'm going to try and draw a line in here, would be about right here. And we can see that that's currently where the market is finding support, right into that blue line, but it's also helping us identify those historical areas of resistance. So this is our next speed bump in the market. If it gets through this speed bump, if it gets through that blue line there, which helps us identify our historical resistance now acting as support, if it opens and closes underneath that blue line, we'll look for it to continue to pressure lower. So as we move forward and move to the next example, we can see that it eventually did move directly under that speed bump, actually came back under. You know, like I said before, historical support can help us identify our next potential resistance. So as it comes back up underneath those historical support levels, they become an opportunity to trade it. So what was once a support barrier, the market broke underneath it, it pushed down into historical support, came back up underneath that level into that purple shaded area, this time as resistance. And the same thing happens down here as it continues down in the downtrend. Remember, we're looking for times when the market changes the trend and then the direction that we're going to want to trade them in. So here's a trend line from this previous trend right here. And we can see that it clearly broke underneath that trend line. The market broke underneath that trend line, opened and closed underneath it. It also opened and closed underneath that purple shaded area. So once it did that, we saw clear evidence that the trend was changing. So once it got underneath that purple zone, underneath that blue trend line, we saw clear evidence the trend was changing, lower highs and lower lows. Then as it came back up underneath it as a resistance into the same area, we could see along that purple shaded area, it found that resistance underneath that purple shaded area as the trend changed, and it provided an opportunity to sell it. There were other opportunities as it continued down in the trend and the trend changed. We saw consistent lower highs and lower lows. So once it made this clear low here, we follow it backwards, and from this blue line, we can see resistance. So once it broke underneath this next blue line, that became a resistance. And so as it came back up underneath it, it gave us a clear opportunity to put in a sell for this currency pair, which is the pound yen. Once it broke underneath this support low and came back up underneath it and tested it as resistance, we can see a clear area where it fell back down, all the way back down here in towards the 1.3860 level. So it continued to pressure lower all the way down there, and really from the time it broke through this trend line, the time it broke underneath that purple shaded area and came back up underneath it and tested it, this area right here on the way back down ended up being about a 700 pip move as it continued to pressure lower from the highs here underneath that purple shaded area and a continuation back down towards the bottom of the chart and a new opportunity to trade in the direction of the trend. Now, I was hoping to have a little bit of time to switch over to live market charts today. I might have a little bit of time to do that. I don't know if I do or not. I don't think I have time to share my live charts today. But what I'm looking at is those clear areas of obstacles in the market. And as you look at some of these strategies that I've been talking about today, go back to the beginning of the presentation that I was talking about. And I suggested that you pick a few of those indicators, master. And really, I've just shown you some basic strategies using support and resistance today. But coming up with a few indicators and then keeping it as simple as possible. Now, I suggested you pick 2 or 3, but I've shown you 4 or 5 today that can work. That's because when they all come together to point to a single outcome, your confidence is going to be increased in that potential outcome. So if you have 2 indicators pointing up and 2 pointing down, it's going to be about a 50-50 shot. But if you have 3 or 4 pointing in one direction, that's when probability will be increased. You know, the trick to trading anything is to using an indicator is to use it correctly and really to use it consistently. Trading is going to be about probability. The more indicators that you use that point to a particular outcome, but keeping it limited to just a few, the higher the probability that that outcome will occur. Now, picking out support and resistance levels and even trend lines for that matter, or Fibonacci for that matter, is often going to be more of an art than a science. And finding exact levels are rarely going to happen. The more often a level of congestion is what it's going to be rather than a single candle or wick. And that's why I use those shaded areas on my charts, the highlighted shaded areas, because I'm looking for a consistent level of congestion rather than a single area. And you'll probably hear different traders that use different methodologies to identify these levels and draw the lines like I've done a little bit today. And that's okay. Find really a method that's going to work for you. And whichever indicators that you settle on, you're going to want to use them consistently. You know, find a method that best represents what the indicator is trying to identify, whether it's volume or momentum or trend or whatever it is, and be consistent with it. If you constantly change the way you are using an indicator, it's just going to really diminish the value of that indicator. So if you are constantly changing the way you draw a trend line or identify support and resistance, it's going to diminish that indicator. And remember, trading is an activity. It's not really a spectator sport. It's an activity. You kind of need to actively participate in the market, or at the moment when all of the indicators converge and opportunity rises, you might miss that opportunity to buy or sell and make some money. And I know this is hard to do because, you know, sometimes if you don't know what to look for, or you just don't have the time to devote to studying the market. Of course, how do I know? That is hard to do because I've been there, as I said a little bit ago. It took me 5 years before I really just had to hit the reset button. Years ago, I would sit in front of my computer and look at the charts and really ask myself, what do I do now? And that's really where some people are, especially with Forex trading if you've never traded the Forex before. And sometimes you'll just sit there and ask yourself, now what do I do? Now that I see all of these indicators on the charts. So take a look at this quote from Benjamin Franklin that I'm putting up here. Tell me and I forget, teach me and I remember, involve me and I may learn. Now, I've said a lot over the past 45 minutes or so, and I kind of talk fast, and I really didn't have a lot of time to talk about everything I'd like to have talked about. And I know you probably have lots of questions, so I hope I've piqued your interest about Forex trading a little bit. And of course, I'll be participating in the class next Friday on May 17th, so I hope to see everybody there. So my time is up, and I'll say thank you for letting me spend some time with you today.
Good deal. Well, thank you, Ross. We appreciate you for sure for taking time out of your Saturday. And guys, we appreciate you guys being here in the room. We've got over 850 people here from all over the world. So again, we appreciate you guys